You may be wondering how we determine where price is likely to go next. Will it push higher to take upper external liquidity, or will it drop lower to collect lower external liquidity? To answer that, we must pay close attention to how price reacts when it enters fair value gaps inside the trading range. This is where directional clarity starts to form. When price trades into a fair value gap, respects it, and especially holds the midpoint while showing rejection to the upside, it is a strong indication that price is preparing to move higher, targeting upper external liquidity. On the other hand, when price shows no respect for the fair value gap and drives straight through it without a meaningful reaction, that gap changes its function. It becomes what we call an inverse fair value gap, now behaving more like a resistance area. If price later retraces into that inverse gap and respects the midpoint again, this time with clear rejection, it becomes an early and powerful signal that the market is likely to continue lower, targeting the external sell-side liquidity resting below the trading range low. So what happens when price action inside the trading range is healthy and efficient, meaning there is no remaining internal liquidity to be taken? How does the market behave in that environment? As discussed earlier, price typically rotates between internal and external liquidity. However, when internal liquidity is no longer present, when price action is clean, balanced, and efficient, external liquidity becomes the primary force driving price. In these conditions, price begins to move directly between buy-side and sell-side liquidity. It targets major highs and lows where stop orders are most likely resting, rotating from one external liquidity pool to the next. This back-and-forth behavior continues until conditions change, until a new inefficiency develops, a fair value gap forms, or a fresh inducement appears. At that moment, internal liquidity comes back into play, and the full liquidity process is restored.